Traders with accounts under $5,000 are risking 5 to 18% per trade, not the 1% that they think. Early in my career, I traded with $1,000 and I discovered 1% was structurally impossible at that size. My broker's minimum forced 3% on every trade, and it took 7 years to scale to where 1% became real. So I'm going to show you the 3 checks that expose your actual risk percentage in under 10 minutes. The first check takes 30 seconds and it starts with one number most traders have never looked at on their chart. When someone starts a small side business, the fixed cost of running it legally don't shrink just because the revenue is small. The accountant costs the same, and so do the registration fees. On $10,000 in revenue, those fixed costs eat 30%, but on $100,000, they eat 3%. The business is identical, but the maths changes everything. Your broker charges a fixed minimum on every market you trade. It's called the broker's risk floor, and it doesn't shrink with your account. Open one market that you trade on the daily chart and add the 10-day ATR indicator. ATR stands for average true range, and that number measured in pips is the minimum distance the market moves on a normal day. It's the ransom the market charges for every entry. Take GBP USD, the British pound against the US dollar, as an example. If the daily ATR sits around 90 pips, then that means your stop loss on this market can't sit closer than 90 pips from your entry, because anything tighter gets eaten by the market's normal daily movement. Every time, write down your market's ATR. That's your non-negotiable minimum stop loss distance, because the market does not negotiate. You pay the ransom or you don't trade. Now, almost every trading book, course, and video teaches the same rule: risk 1% per trade. But on most accounts under $5,000, 1% is physically impossible on some popular markets most people trade. In December 2016, I deposited $1,000 into my first serious trading account. I already knew the 1% rule, or I thought I did, and I had been studying and trading for over 3 years at that point. 1% of $1,000 is $10, but I checked my broker's minimum trade size against the markets I was trading, and the smallest possible risk per trade came out to around $30, which was 3 times what 1% allowed. So I set my risk at 3% because the structure of my account and my broker left no other option. And I told myself, it will sort itself out once I start winning. A few good months and the percentages won't even matter. That's the thought that keeps every undercapitalized trading account alive just long enough to bleed out. That gap between $10 and $30 felt small, but across dozens of trades, it's the difference between an account that survives and one that bleeds out while the trader blames their strategy. I spent 7 years growing and depositing into that account. $1,000 became $2,500, then $5,000, then $7,500, then $17,500. And I reduced the risk when the account allowed it from 3% to 2%, then held at 2% until the account was large enough for 1%. Here is check number 2. Look up your broker's minimum lot size for the market you choose. For most brokers, that's 0.01 lots. On gold, the contract size is 100 ounces, so 0.01 lots gives you 1 ounce. That means every dollar gold moves, you make or lose $1. Now, multiply that by the ATR number you wrote down. $1 per dollar move times $100 ATR equals $100. That's the absolute minimum your broker will let you risk on that single gold trade. And it applies regardless of what your trading plan says. Check number 3, divide that number into your account balance. If you have a $500 account, $100 divided by $500 is 20%. But I set my risk at 1%. I did everything right. You set 1%, your broker charged 20%, and no one told you. If 1% of your account is less than the minimum dollar risk your broker forces, your account is structurally dead for that market. That's the DOA check, dead on arrival. And the free diagnostic quiz in the description below can run it across every market in your account. The link is right below this video. So check it out and get your diagnosis today. The threshold for gold at this volatility is $10,000. Below that, 1% is a fantasy on this market. Your account was already dead before you placed your first trade. Most traders who discover their account is too small do one of two things. They deposit more money to fix the number, or they ignore the result and keep trading anyway. Dr. Van Tharp was a trading psychologist who spent decades studying what separates profitable traders from everyone else. He created a simulation called the marble game. Every participant received an identical system with a known positive edge. Same signals, same win rate, same reward. The only thing each trader controlled was how much to risk per trade. Some risked heavily to grow fast, telling themselves, I just need to be aggressive early, and then I can back off once the account is up. They blew up. Others risked so cautiously their gains barely covered the time invested, and a small group sized their risk to what their account could actually sustain, and they compounded steadily. The system was identical. The only difference was whether the account could structurally support the risk each trader chose. Every time you set a 1% target on a trading account that can only structurally deliver 5 or 10%, you are the trader in that experiment who sized for an account that they did not have. If your DOA check came back red, stop live trading on that market. Switch to a demo account and start saving toward the threshold your check revealed. Your trading skill keeps building on demo while your capital catches up through your salary. I followed this exact path for 7 years. If your check came back green, your account is structurally viable and the 1% rule is physically possible, which means whatever is costing you money in your trading account comes down to strategy, execution, or discipline. And that's a different diagnosis entirely. No broker will tell you this because they earn fees on every trade you take, regardless of whether your account can survive it. Tonight, open your chart, pull up the daily ATR on the market you trade most, and run the 3 checks. If the number comes back red, you've just saved yourself from every trade you would have taken on a dead account. That's the trader who stops fighting a rigged game and starts building the account, gives the rules a chance to work. But this check won't tell you where to place your stop loss once your account is viable. Get that wrong and it costs the same money for a different structural reason. So watch this next video where I show you the volatility-based stop system that turns your ATR number into an exact stop loss for every trade. So see you in that video.